Welcome to Top Stock Picks. I am your host, Jay Taylor, here with you to launch this new weekly podcast as an adjunct to my weekly radio show, Turning Hard Times into Good Times. That's aired live every week on the Voice America Business Channel at 3 p.m. New York time, every Tuesday actually. Believing that we are in the early stages of a major bull market in precious metals and not finding a sufficient amount of time to expand coverage of many junior mining companies on my weekly show, I have chosen to begin providing additional coverage with the help of independent newsletter writers who appear at the Metals Investor Forum. And so as I started several weeks ago to interview each of the speakers at the Metal Investor Forum, I am continuing to do that today with Jordan Roy Byrne, and he is a regular speaker there. I've listened to him many times. He's a very entertaining speaker, and he has a lot of good things to say, a lot of interesting things, maybe not always what we want to hear, but he calls them as he sees them, and for that I have a great deal of respect for Jordan. Thanks for joining me today, Jordan.
Hey, Jay, it's always a pleasure to speak with you. Thank you for the very kind intro.
Well, always good to talk to you, and again, I try to find guests that will hone in on the truth, even if it isn't what they themselves want to hear sometimes. So, it's all too tempting sometimes to believe what we want to believe rather than what reality is. And I think that technical analysts, well, maybe there is an art or an ability to sort of see things in various ways, but nonetheless, I think the effort on most technical analysts that I know is to try to hone in on objectively to what the markets are really telling them, what the language of the markets are saying. So I respect that. And since this is the first time that you're on my podcast, Jordan, can you tell our listeners a little bit about your background, about your educational background perhaps, and how you came into your interest in technical analysis and writing your letter?
Well, I'll try and be as brief as possible because I can ramble on about things. But let me get right to it. I started investing when early in high school, and I got in during the tech stock boom. And I got in early enough that I didn't. I still made a good deal of money, but I lost a lot of my gains. I got in there, I think, very early 1999. I thought I was a genius like everybody else. And my problem was not because I did sell stocks and take profits, but my problem was I kept buying on the way down, thinking like, oh, well, this is a great discount. These things are going to go back up now. I was doing that in 2001 and early 2002, and then I realized there has to be another way to understand why markets are moving the way they do. And I mean, fundamentals are just technicals, like you said, they can be more of an art than a science, but I think technicals are more objective because they're based on factual data. Whereas now, look, technicals, they're always subject to interpretation. I mean, we talked before about how you could come up with any great technical analyst can they know enough to give a bull or a bear case for anything. I mean, there's so many different things they can use to explain that. But really, with fundamentals, to me, fundamentals are a lot more subjective than technicals, because technicals you're looking at objective data, and like you mentioned, I mean, I like to look at fundamentals and technicals, but I think if I only had to have one, I would go with technicals. But anyway, in the early 2000s, I had some very sharp people telling me, well, gold's going to be the next big thing, and so I was studying technical analysis, and that's how I kind of got into investing in gold. And when I went to school, I was more concerned with learning about technicals and trading and investing in stocks. I'd be checking my stocks, sitting in the back of classes on my laptop, checking stocks during lectures. But I did finish my schooling, and I got a general studies degree. But I did the Chartered Market Technician program through the Market Technicians Association. That takes about 1.5 years. There's 3 exams. So I finished that 7-8 years ago, maybe 9 years ago, something like that. And in the last year, there's an international master's program where you write a paper, and if they accept it, they give you what's called a master's in financial technical analysis. So
okay.
I was fortunate enough to pass through that, and my master's thesis was actually on the 400-day moving average, or the 80-week, 20-month moving average. If you follow my work as you do, Jay, you know that I prefer that moving average to the commonplace 200-day moving average. And what my thesis showed was, in terms of a sell signal breaking for various asset classes, breaking the 400-day moving average is more significant than breaking the 200-day moving average. So that all of that, I mean, that sums up kind of my career with respect to technical analysis. And on the investing side, like I said, I was fortunate enough to get into gold and resources. I was in energy first in the early 2000s, then went into gold 2004, 2005, and I've been a believer in precious metals since.
What caused you to migrate from the IT sector to the precious metal sector? And you're not the first sort of technically orientated guy to do so.
Well, the precious metal sector and commodity, the simple answer is I went from what was going down to what was going up.
Okay.
But I'm kind of a contrarian at heart, and I kind of have a tendency to be contrarian for the sake of contrarian, which you want to avoid. I mean, I as you know, I'm very conservative and a little more maybe over the, I mean, I'm critiquing myself. Maybe over the last 12 or 18 months, at times I've been a little too conservative on the sector, and I guess it's like a natural tendency to be contrarian because, as you know, Jay, there's so many people in this sector where it's kind of everything is knee-jerk bullish. Doesn't matter what's happening, everything's bullish.
Mm-hmm.
10,000 gold is going to happen, and maybe those people will be right one day. They probably will be. I don't think it's going to happen anytime soon, but I guess for me it's just kind of a natural tendency to be contrarian, and given the way I see things, I mean, I am a little cautious and bearish right now. I mean, it's more than just being a contrarian.
All right, I want to ask you about that in a minute or two, but before we go any further, so people can follow your work, where can they go to learn more about what you're doing, Jordan?
They can go to thedailygold.com. I give away a lot of free info there, so you can opt in for my free newsletter and maybe follow that work. I mean, I do lots of interviews like this and video updates, and I write a free article every week, and so people can kind of get a sense of what kind of work I do and if it's right for them.
Do you make your master's thesis available to those that might be interested? Is it posted on your website or any place like that?
It was published in the International Journal of Technical Analysis. I think I don't know if I have that name right, but I haven't put it on my website yet. I think, I'd have to.
Might be the kind of thing.
Website.
Might be the kind of thing that a lot of people, if it's very technical, it may not be something that interests the masses, perhaps. But
right. But if anyone wants to see that, I'd be happy to email that to them. Jordan@thedailygold is my email.
Okay. Very good. Thank you for that, Jordan. I might have to do that myself here now. Well, you mentioned you prefer the 400-day moving average over the 200, which is the popular one, of course. And would you like to explain a little bit more about your approach to technical analysis? I mean, what is it? Just how do you do it? Because there's so many different ways, so many different kinds of technical analysis, right?
Right. Yeah, that's a great question. Nowadays, I'm focusing quite a bit on just price action and moving averages. I don't do trend lines because trend lines are too subjective, and a lot of people who draw trend line, like for a trend line to be significant, the market really needs to be touching that line more than 3 or 4 times. Like we see these people because look, any line has 2 points.
Yeah.
So that's why I generally don't use trend lines. I like moving averages better. And just studying pure price action. The other thing I really like is intermarket analysis. And this is big for the sector that we're in, Jay, because as we know, I mean, the stock market affects gold, currencies affect gold, bond market, interest rates, et cetera. And so I really like looking at how other markets are performing, how that's impacting gold. So I do quite a bit of ratio analysis with respect to gold. I'm looking at how is gold performing against foreign currencies, how is gold performing against the stock market, how's gold performing against the bond market. One thing I don't do is correlation analysis. I mean, we have a lot of people who are just saying, oh, well, gold's right now. They're saying gold's the yen. Just follow the yen because that's gold. And I mean, that's really, I mean, that's not going to work. At some point, you'll get completely thrown off. I mean, gold goes up and down for its own reasons. Correlations, I mean, they can last a while, but generally they're pretty temporary. But basically, I like to study pure price action, moving averages, and a lot of intermarket analysis mixed in.
Yeah, well, so speaking of one correlation that people a lot of times refer to, and that's the gold and the dollar index. And I suppose, when you have a weak dollar, it tends, since everything is priced in dollars, you tend to have higher prices for copper, for oil, for everything else, gold included. But you don't pay that much attention to it. And certainly recently we've seen that not hold up so well. We've seen, both the dollar and gold be somewhat stronger at the same time. And so I quite agree with you. But there are some of those interrelationships that do matter a great deal, as you say. And I think that's very important. I don't think you can look at any market in isolation necessarily, right? But I'd like to ask you about your view of the dollar now. Do you have the dollar index, let's say? How do you see it? We've seen on the index 99 being kind of a key area. It seems to be perhaps somewhat crucial.
Yeah, I mean, looking at the long-term moving averages, like the 200-day, I mean, that's at 99. The 400-day is 97.80, so we can round that up to 98. But really, I mean, the dollar, the major support, I mean, it could break below those moving averages, but the major support is really around 93. So, I mean, it's possible the dollar could come down well below those levels and make a higher low at 95 or even 96 and then rally after that. I mean, currencies are a bit different because there's so many. I mean, the dollar index, you have the yen impacting that, you have the euro. So I think currencies are different than when you're just analyzing like a stock or a stock market or a bond market. They're more singular markets, in my opinion. So with respect to gold, I really don't have a strong view on the dollar. Gold really leads the dollar in the big picture. I mean, gold really crashed 2013, and the dollar didn't really get going until the summer of 2014. And I mean, by that point in time, gold had already hit a low of basically 1,200 or 1,190 at the very end of 2013 or the beginning of 2014. So gold really had its big move down in 2013, well before the dollar really perked up. Now, that's not to say that that relationship isn't in effect anymore. I just think that in the big picture, gold is leading the dollar, and that's why right now gold does not look good technically. I'm concerned. And if the dollar was really going to go a lot lower here and now, gold would be much higher. That's just in my opinion, the dollar bears, because I have seen some work out there. And again, technicals are always open to interpretation.
Sure.
So this is hard to be objective. It's kind of subjective analysis here. But if the dollar really had just made a major top and its cyclical bull market was over, gold would be at 1,300 or even above 1,300 right now. So the weakness in gold overall is telling you that the dollar is probably not going to go that much lower.
Oh, interesting. That's your take on it. That's very interesting. And well, you could very well be right about that. I'm kind of hoping you're not, but that's we thank you for telling it like it is, or as you see it anyway. So the gold shares, gold shares seem to be weaker even than gold, right? More recently.
Right, and it's interesting because they were so much stronger at the beginning of the year. They had this fantastic relative strength, and I mean, look, it completely turned around. Gold, the strength, as you know, Jay, the shares usually lead the metals, and the shares were really strong early in the year, and then they kind of peaked out sooner, and then gold kept rising, even all the way to 1297, which was pretty impressive. But the lack of relative strength in the shares, not even being able to make a recent high while gold kept going higher, always a bad sign for the sector. Not necessarily immediately, but eventually it's always a bad sign. And as you said, I mean, they're still weaker than gold. I'm just looking at the shares. I mean, GDXJ is kind of its own mess, but looking at GDX, I mean, I think both are definitely going to test their December lows. And if you put a gun to my head, I would say I think the low this year will probably be lower than the December lows. But as I said in my MIF presentation, Jay, the lower these things go, to me, that's really an excellent long-term buying opportunity because of other factors. Which, I mean, I don't know if we want to get into that, but if the miners break the December lows, a technical analyst would probably say, "Oh, that's a breakdown. This is a sell point." But for other reasons, just because we had this major bear market and we had this massively oversold sector in early 2016, and the fundamentals of the larger companies, I mean, they've really turned. And in my opinion, there's after you have a long bear market and a nasty bear market like we had, there's not enough sellers left to push that market much lower. Like if you're only a year or two after the fact. So that's kind of my view on that. If I'm looking for a low later this year below the December lows. But I mean, if that happens and we get there, I think people would be concerned that there's a breakdown, that we're going to go back to the lows. But for me, that's a real buying opportunity.
You're talking, I guess, how do you define short-term or medium-term, Jordan, and how do you see gold in the longer term, if you might define that as well?
I guess short-term for me would probably be anywhere from a week to a month. Medium-term, probably 4 months. Medium-term or intermediate-term, I guess you could get 6 to 12 or 6 to 18 months, and long-term would be more than that. You saw my presentation, so you know that I'm concerned about metals for most of the rest of this year. But looking at, I do a lot of historical analysis also, and looking at, like last night, I was just looking at gold's biggest rallies coming off of bottoms. And so let's just presume that I'm right and metals prices are going to get weaker. They'll make a low later this year, end of the year maybe. If you look at gold's strongest moves after its two strongest moves after the low in 1976, the low in 2008. Even if, like, this is scary to say for some people, but even if gold went down, let's say it went down to 970, for example, and that was the next low. Well, its strongest rallies that I mentioned, those two strongest rallies, that an average of those would have gold reaching 1490 about 12 months later. And even gold, those two rallies, I believe they rallied about 35% or so within the first 4 months after the bottom. So the point I'm trying to make here, Jay, is that people will get really scared, but if gold if it goes to 1,000 or a little bit lower, once it rebounds from there, it's likely to be a very strong, quick, vicious rebound. And we could get back to 1,300, relatively quickly in 4 or 5 months. And I'll just throw in something on silver, which I pointed out in my presentation. Silver in the past, silver's had 3 6-year bear markets, and after those points, silver's average rally in the 12 months after was roughly 85%. Two of those rallies were almost 100%, and then that's not even counting the 2008, the rebound from 2008, which I think was 100% in a year. So, I mean, it sounds really bearish for me to say, yeah, well, silver could hit 13, that could be its next low. But if you factor in history, that tells you, well, a year later it could be at 24, 25, 26.
Yeah, pretty good return if you can pick the bottom or get in more aggressively somewhere near the bottom, I guess. So, and I know that's what you're trying to help your subscribers do. Well, Jordan, we do need to take a break here, but you just spoke about the JDXJ, and when we come back from the break, and for the sake of my listeners who may not be familiar with how that ETF, which buys junior gold shares, has had such a negative impact on the junior share market, I'm going to ask you to explain that as soon as we come back from the break. So, folks, don't go away. Join us in the next segment. We'll be right back.